Okay, so thank you very much for attending the presentation. Thank you for a great conference. Meng, wherever she is, been wonderful wherever you are, organising things and sorting out logistics. So thank you very much. This paper started off was going to be a micro piece of work, and then we looked at some gem data, which turned out to be horrible and messy and just terrible. Which I shouldn't really be saying that because someone in my department at Aston University actually runs the GEM project, so I'm kind of trouncing my own institution there a little bit. But so we went to more of a macro approach because we knew the data was actually more useful there. The paper's motivated because the finance and growth nexus has typically weakened in contemporary periods. So if you grab some data, some empirical data, and ran some regressions, including data from the 2000s, you'd probably find that you have an insignificant coefficient on credit or financial deepening on its impact on economic growth. Okay? And there have been various papers and researchers tried to explain why the finance growth nexus has weakened. And there's been two kind of strands of literature that have tried to explain that. And the first says there's too much finance, and the second says that perhaps financial crises or financial fragility play their role in weakening the finance growth nexus. Now, with those two main hypotheses, it's kind of bizarre when you look at Sub-Saharan Africa, and it's kind of idiosyncratic and heterogeneous compared to other worldwide regions worldwide. Typically, if you're looking at a turning point in finance where the financial system's become too big, private credit in Africa is well below this documented threshold that many of these papers suggest. So I'll just go to this next little graph here. And over our sample of 2006 to 2016, we can see that private credit as a percent of GDP is about 32%. And most turning points suggest that when the financial system becomes too big, the turning point is around 110% of GDP. So this is miles away from that kind of threshold effect. And other stories suggesting financial fragility and financial crises, well, again, if you look at the Leuven and Valencia data set who model banking crises, in Africa, there's a rather silly kind of story here where from 1973 to 2000, over half of sub-Saharan African countries have faced a financial crisis. And 20% of Leuven and Valencia's data set have crises from sub-Saharan Africa. But then moving from 2000 onwards, only 2 crises, or banking crises, have been documented in the Leuven and Valencia data set from sub-Saharan Africa, showing that there's this peculiar pattern or peculiar story going on. So why isn't finance working in Africa? Well, Panicos and Gregory James have a paper saying that what's happening there is that bank balance sheets are expanding, but this credit is not being sent out to businesses and firms. One thing is, why we're looking at the finance growth nexus, maybe we should be looking at something else. Should we be looking at the business channels? Are financiers lending to businesses, and it's something else which is impeding a business from attributing to economic growth? And based on that, we have our research question. And we actually answer, does financial deepening increase new business startups? And this is quite a nice contribution of ours because most of the work prior to ours looks at existing small and medium enterprises or just existing enterprises or focuses on growth. There isn't much work out there which has looked at new business startups. Okay? So we focus on the channels of how finance may impact growth, and we posit that if finance can create more business startups, these business startups may then therefore grow themselves by the process of creative destruction, contribute to economic growth in the wider aspect. And we look, is there a differential impact in Africa compared to the rest of the world? And of course, we put an additional focus on financial fragility because in our previous ESRC grant that we had, that was the main focus of that grant. So it's a nice continuation into Victor's project as well. So if I do run out of time, which is possible, I'll tell you the main results now, so I'll give the game away so we don't miss it, is that we step away from cross-country regressions looking at finance and growth. We don't focus on existing SMEs, but new SMEs, and we find that finance does not influence new business startups elsewhere in the world, but we have differential results in Africa. So increases in financial deepening is correlated with an increase in new small business startups and new business startups. Okay? In addition, what we find is very nice is that we play around with the estimation strategy and our results are very robust. And it's a case that sometimes when things are too good to be true, you think, is this happening? But we've played around with instrument subsets, and the results are very consistent throughout. So there was pretty much zero data mining going on when we look at these things. So we feel that we have found a good relationship. And we also introduce a new instrument for financial deepening, which is a measure of gender equality, which is probably why we're in the gender session here. So moving on to the pre-literature. So pre-2010, financial deepening may increase economic growth. And from the King and Levine paper in 1993, a lot of policy was driven, increase the size of your financial system, and you will reap the benefits of economic growth. So many international agencies, the IMF and the World Bank, promoted these kind of policies. Torsten Beck in 2000 looked at these kind of system GMM estimates and said that, yes, there is a causal impact from finance to growth. And Beck and Levine in 2004 said, hang on a second, it's not just the banking sector, but the overall financial sector. So even if it's via stock markets, you can still get this positive association. Then in the mid-2000s, certain caveats arose, mainly by Felix Rioja and his papers, where in Economic Inquiry they said that finance is good for growth, but predominantly for middle-income countries. And then in their Journal of Development Economics paper, they suggested that the channels of finance differ between income levels. So for the lowest income countries, finance contributes to greater economic growth via the capital accumulation channel, whereas for those richer countries, it's via productivity channeled. And then the crisis hit, and we needed a scapegoat. So post-2010, it was the financial system has become too big. It's become the master of the economy and not the servant of the economy. Okay? And Christine Neer has a nice job market paper in 2013 when she was in the market, explaining how finance was absorbing talent from other areas of society into finance due to these high rents. There's the Arkand paper in the Journal of Economic Growth suggesting these turning points, and there's been many springboards from that. And there's Panicos' paper with Peter Rousseau and I, which try and explain this breakdown in the financial system, and we claim that it's financial fragility that has impeded this finance growth nexus, where once you attribute financial fragility, then you can recover, or you don't have a negative coefficient on private credit to economic growth anymore. So that's most of the macro literature. Going to the more micro literature, which is where we're more working alongside. Beck, in the Journal of Banking and Finance 2006, said that small and medium enterprises struggle to receive funding. We all know that. But then 2 years later, they claimed that if you provide funding to small and medium enterprises, they get greater growth benefits than providing the same amount of funding to an existing large enterprise. So they're really focusing on getting access to finance to small and medium enterprises because they contribute the most to economic growth. Aguillon et al. In the Review of Economic Studies provide various hypotheses. It's basically these new firms come in and disrupt existing channels, and via technology transfer, we create economic growth. And Ayagari et al. Prove that empirically, showing that it's the smallest firms who contribute the most to economic growth based on these hypotheses. And then in 2011, there was a paper by Clapper and Love in Economics Letters showing that focusing on R-dependent variable, which is the only study we've found so far, looking at that at the macro level, that financial crises harm new firm creation. Okay? So that's in a nutshell a quick overview of the literature and how we situate the paper. So empirical strategy involves a fixed effects equation where a dependent variable is new business startups, have our country-specific intercept, and to start with we want to look at equation 1, where we just have financial development for all countries in the world, coefficient of interest is phi, our matrix of covariates, time dummies, and our error term. And then we look at our Sub-Saharan African effect, where we introduce private credit in Africa as an additional conditioning variable. So what we're interested in is the combination of phi and rho, which is the effect of private credit in Africa on new business startups. Our preferred estimation strategy uses instrumental variables, but we do show you the fixed effects results nevertheless, where we have a typical two-stage setup. Okay. Talking about the instruments, we always use an over-identified model, so we can look at the Hansen test and test whether our instruments are valid. And our instruments are both traditional and non-traditional instruments. So the traditional instruments are those that you're typically finding in a kind of a system GMM, but without that horrible black box where you don't know what's going on. So we use the second and first lag difference of the endogenous variable as an instrument. Okay? And then we also use other traditional instruments like legal origins. Now, you might put your hand up here and say that you're in a fixed effects regression. Aren't legal origins time invariant? So how's that working? Well, how that's working is that we interact our legal origins with our variable of gender equality, so they become time invariant, and we can put them into specification. Now, going on to the theory suggests that if you inherited British common law as your legal system, you're more financially developed vis-à-vis to all nations who didn't. And if you inherited a French civil legal system, then you're financially underdeveloped than all other nations vis-à-vis who inherited other legal systems. And we interact that with our gender equality variable. Our gender equality variable is just purely proxied as the number of females enrolled in school divided by the number of males enrolled in school. So a high number of that ratio indicates greater gender equality. And we posit that societies that are more inclusive in gender equality should be more inclusive in finance and therefore have deeper financial sectors. With our interaction terms, we propose that countries who have well-developed financial systems, this gender equality will be less important, and nations who have financially underdeveloped systems or who follow the French legal code, this gender equality variable will be even more important. And we play around with all these different sets and subsets and find very nice results. So the data comes from, it's all World Bank data and comes from 3 different databases. The World Development Indicators, where most of our control variables come from. Our financial variables come from the Global Financial Database, and our dependent variable comes from the Doing Business database. And they're all World Bank, so they're all parsimonious and quite reliable. And we have 91 different countries, spanning over 11 years, and we have good country coverage for Africa. We have 19 nations in our 91. Of course, you'd have, 1,001 hypothetical observations, given data availability for certain covariates. Our sample falls to about 700, which is obviously the case when we start to look at lag differences as well. Now, the key variable, our dependent variable, is newly formed private businesses, and these are limited liability private businesses divided by the working population. And this is why we've only focused on private credit as our measure of financial deepening, because we are comparing apples and apples, or oranges and oranges for that sake, that we are looking at funds from the domestic banking sector going to private firms, and obviously we've got private firms here in the model. Okay? We could have used other measures of financial deepening, such as liquid liabilities to GDP, but as Panicos' 2011 paper suggests, that bank balance sheets grow, so liquid liabilities do increase, in particular in Sub-Saharan Africa. It's whether this credit is being loaned out, which is the problem. So I overruled kind of Panicos there, and I just didn't download the data and didn't tell him. So this is the first time he's aware of it. And we have 2 sets of conditioning variables, a basic set and a full set. The basic set looks at GDP per capita, just to control for income levels. We have economic growth, to measure business effects, and some measures of financial fragility, including non-performing loans and the Z-score. Super, yeah. And then we have a full conditioning set, which includes population growth, measure of human capital, inflation to measure macroeconomic stability, and trade openness as a further conditioning set. So these are our first preliminary findings, and they're just fixed effects regressions. So columns 1 and 2, so each column represents a different regression. Columns 1 and 2 represent this first empirical equation. Columns 3 and 4 represent this second empirical equation. And if we look, that if we include all nations together in a sample, that we get a positive and significant effect on private credit for new business startups. So all these variables are logged, so you can interpret this as an elasticity. So a 1% increase in credit will result in a 1% increase in new business startups. Okay? Just mention all the conditioning variables are included in the specification. It's not univariate regressions. Okay? Then when we estimate our second empirical equation and we separate Africa from the rest of the sample in that sense, we find that, hang on a second, this effect no longer becomes statistically significant, and the effect is actually being driven by Sub-Saharan African countries. This looks like it's only significant at the 10% level. Once you can do the linear combinations, so you add the two coefficients together, we get statistical significance at the 5 and 1% levels in those things. So we actually find some nice findings there. Then we move on to our preferred estimates, which estimate the previous table, but these include only the second lag and first lag differences of the endogenous variables as an instrumental variable approach to identify the coefficient. And what we find is, to start with, looking at the diagnostics, we've got very strong instruments, and they all appear to be valid, with p-values exceeding 0.1 in the first stage, in the second stage. In the first stage, all instrumental variables had their predicted coefficients. And what, again, we find is that a much stronger effect in this instance, that credit in Africa is increasing new business registrations. In particular, you're looking at an elasticity of 0.7 to 0.9 there. Okay. And finally, as robustness tests, we fiddle around with the instrument set, and in columns 1 and 2, we add gender parity into our instrument subset. Again, results remain robust and sitting between that 0.7 and 0.9 elasticity. In columns 3 and 4, we look at our interactions with legal origin and gender equality. And then in the final column, we omit the second lag of private credit, and we still find that we get just about statistical significance there. In all cases, apart from in column 5, do the instrumental variables fall below the target figure of 10. And in all cases, the Hansen p-value exceeds the value of 0.1. So they're showing that we do have an effect where increasing private credit or increasing financial deepening is associated with an increase in new business startups. Quickly move on to the financial sensitivity analysis. 1 minute, yeah, super. Done this really well. We've played around with further alterations to the instrument subset. Nothing changes. We've also cut the sample to Africa. We lose many observations and degrees of freedom, so that's why I prefer our own approach, but the results were consistent here, in particular in fixed effects regressions. We restricted the sample size to 593 observations for every single regression we ran, because if you notice in the previous columns, the observations vary. Again, nothing changes. And there's another measure of business startups, not divided by population and standardised, but just the raw value. The results do then become too good to be true, so we don't report those, but the results are consistent with that. In a nutshell, financial deepening may increase new business startups in Africa, and these new business startups may enhance innovation and fuel growth, and hopefully get Sub-Saharan African countries growing and reducing poverty via, if you assume that growth is good for the poor, as Dollar and Cray do. Not reported were some of the coefficients. Non-performing loans was negatively correlated with new business startups. You'd expect that to be the case. If you have a fragile financial system, banks are not willing to lend money out. And these results complement Clapper and Love, who look at financial crises and new business startups. Overall, results are stable for a variety of robustness tests. As I said, we've played around with sample sizes, instrument subsets, and we've played around with the matrix of conditioning variables. And have I done that exactly in time?
Yes.
Super.
On time, just 2 minutes.
Super.
Good.
Yeah.
So, yeah, we have 10 minutes Q&A.
A very small question.
Okay.
You started by saying that private credit or financial development wasn't working in Africa.
Yep.
Yeah. And did you test your equation also in general? So whether indeed it isn't working? And second,
Okay.
what can we learn here from this very first question you had that private credit isn't working in Africa?
Okay.
So let's take 3 at a time. So what? Yeah.
I'm waiting until
Yeah, I
Kenny
can.
puts her hand up.
Yeah. So. Yes. Okay. Good.
I just want to know what African countries are included in the sample, because you said 19 countries. Are they from the West Africa or from what part of Africa?
Okay.
Okay.
All right.
A quick question. There are known sampling biases in doing business. So how reliable do you think it is for capturing new SMEs?
Okay. It's up to
Okay.
you.
Right. If I knew there was going to be 10 minutes of questions, I would have talked for 29 minutes here. You see, you pulled me off. I'll start with yours, Oliver. I'll look back into that and give you probably an answer. And so we'll look into that. So we've not. I need to talk about what kind of biases have we got in there.
Oversampling of larger firms is one.
Is it? Okay, because these are new ones, so I'll double check that and see what that is. The lady at the back, it's a panel, it's just throughout Africa, scattered throughout Sub-Saharan Africa. The paper which is available, I think Meng sent an email link out today, we have a country list in the appendix there, so you can look at all the 19 countries that are in there. And then going to Robert, we haven't done that, and I think we will next, shall we, Panicos?
Well, then can I say something about, obviously, when you look at the formal definitions of financial development, I have a paper with Gregory in Economics Letters on that, right? So when you look at private credit and growth, it just doesn't, you know, there's no action, right?
I know that.
That's-
I know your paper.
Okay. Although on liquid liabilities basically follow. So basically what happens there is that in terms of the size of financial systems, there is evidence that financial deepening happens because of economic growth. But there's no evidence that it's the other way around. We think that this offers some hope in that, at least in the last 15 years, we see private credit in Africa to be helping business startups. And that's a channel for growth. And I mean, in fact, it's perhaps even more important challenge for growth than looking at the macro aggregates, because business startups are meant to be good for competition, they're meant to be good for innovation, for R&D, and etc. So they are a channel of growth, right? So we think this is hopeful, actually. But on the other hand, there is a result that, again, Johan has emphasized about financial fragility. It's a marginal effect, right? You increase private credit, but effectively you're assuming that financial fragility remains constant, right? So if by giving more credit to these startups, you end up having more impaired loans, then it will negate it, right? And maybe that's what's happening in the macro picture, where everything goes in the wash, right?
Yeah.
So we are assuming that impaired loans remain constant. In fact, as you will know, we have several other papers which say that the reason that banks are not lending in Africa is because of the credit market imperfections and the fact that they have too high NPLs. They're too scared to lend. It's too risky to lend. And I think we've had the governor say that this morning, and some other people also.
But I'll be able to check. I'll be able to get your result for that by the end of the day, actually, I think. So we've got the variables, it's just changing it, so, yeah.
Okay. It's second round.
Okay. Oh, second round.
Second round of questions.
Yeah. We already. I thought yes. Quickly.
Okay.
So, yeah, okay. I want to know, maybe in the paper that will be detailed, the transmission mechanisms, because for an enterprise to grow in whatever form, you know, the assumption you are making is, you know, through influence of finance as an enabler, a catalyst, or a driver. But we know the environment in which makes businesses thrive. So the power of other contributors to that will be important.
Yeah. I just want to know that you mentioned something about evaluating the impact of gender on entrepreneurship or the impact of gender disparity. Thank you.
Yeah. Just a quick follow-up. Have they set all effect, like agriculture versus service?
We've not done it, we've just looked at raw value, yeah. So answering the gentleman's question quickly. So the transmission mechanism, we're not looking at what happens for existing small and medium enterprises. We're just looking at what happens for new business startups. We don't really care what happens beyond that for the time being. We just see what happens there. So that's kind of this transmission mechanism where finance was broken for growth. So our finance doing their job and actually channeling funds to new businesses. And then we kind of stop at that point and we assume that then they're on their own, they've got the funding, it's up to them, and then hopefully finance is doing the right thing to monitor and making sure that they've not just got the money and ran off and bought themselves a private jet or whatever. So we don't go any further than that. For the lady who asked about the gender disparity, so we just use that as an instrumental variable to try and explain differences in financial development across the world. So what we're saying is that if you have a more inclusive sector in terms of gender equality, we assume that societies that are more inclusive in gender will be more inclusive in finance, and therefore they'll have a larger financial sector. So that's what we're trying to use with that.
Good. Thank you.
Okay, thank you.